Well, hello everyone. Good morning and welcome to Mortgage Monday on June 18th. Today's topic is factors that affect mortgage rates. Again, this will be a short presentation. It's probably going to be about 7 or 8 minutes. After that, we'll have a Q&A for anybody who has any questions for me during the presentation. If you have any, you can also write them up in the chat and we can go over them at the end. And let's just start. Okay, so factors that affect mortgage rates. Mortgage interest rates have a very significant impact on the overall long-term cost of purchasing a home with financing. On one hand, mortgage borrowers are seeking the lowest possible rates. On the other, mortgage lenders have to manage their risks through the interest rates they charge. The lowest mortgage interest rates are only available to borrowers with the most solid finances and sterling credit histories. While the financial health of borrowers affects how good an interest rate they can get, larger economic factors and government financial policy affect the whole mortgage rate universe. You can boil it down to these 5 important factors. All represent basic rules of supply and demand in one form or another. It's a little technical, but learning these principles will give you a good way to think about what you're paying now and what could be coming in the future. Inflation. The gradual upward movement of prices due to inflation is an important factor in the overall economy and a critical factor for mortgage lenders. Inflation erodes the purchasing power of dollars over time. Mortgage lenders generally have to maintain interest rates at a level that is at least sufficient to overcome the erosion of purchasing power through inflation to ensure that their interest returns represent a real net profit. For example, if mortgage rates are at 5%, but the level of annual inflation is at 2%, the real return on a loan in terms of the purchasing power of the dollars the lender gets back is only 3%. Therefore, mortgage lenders carefully monitor the rate of inflation and adjust rates accordingly. The level of economic growth. Mortgage rates are also influenced by economic growth indicators such as gross domestic product, GDP, and the employment rate. Higher economic growth levels generally produce higher incomes and higher levels of consumer spending, including more consumers seeking mortgage loans for home purchases. That's all good, but the upswing in overall demand for mortgages tends to propel mortgage rates higher. The reason? Lenders have only so much money available to lend out. Naturally, the opposite effect results from a weakening economy. Employment and wages decline, leading to decreased demand for home loans, which in turn puts downward pressure on the interest rates offered by mortgage lenders. Federal Reserve monetary policy. Monetary policy pursued by the Federal Reserve Bank is one of the most important factors influencing both the economy generally and interest rates specifically, including mortgage rates. The Federal Reserve does not set the specific interest rates in the mortgage market. However, its actions in establishing the Fed funds rate and adjusting the money supply upward or downward to influence the growth of the economy have a significant impact on the interest rates available to the borrowing public. If inflation fears are strong, the Fed will increase the Fed funds rate to curb the money supply. But in times when there is little risk of inflation, they may drop it or stay the same, and mortgage rates may likely fall. Generally, a growing economy with inflation leads to higher mortgage rates, and a slowing economy leads to lower mortgage rates. The bond market. The movement of the 10-year Treasury bond yield is said to be the best indicator to determine whether mortgage rates will rise or fall. But why? Though most mortgages are packaged as 30-year products, the average mortgage is paid off or refinanced within 10 years. So the 10-year bond is a great bellwether to gauge the direction of interest rates. Treasuries are also backed by the full faith and credit of the United States, making them the benchmark for many other bonds as well. Additionally, 10-year Treasury bonds, also known as intermediate term bonds, and long-term fixed mortgages, which are packaged into mortgage-backed securities, compete for the same investors because they are fairly similar financial instruments. However, treasuries are 100% guaranteed to be paid back, while mortgage-backed securities are not, for reasons such as payment default and early repayment, and thus carry more risk and must be priced higher to compensate. Typically, when bond rates, also known as the bond yield, go up, interest rates go up as well, and vice versa. Don't confuse this with bond prices, which have an inverse relationship with interest rates. Investors turn to bonds as a safe investment when the economic outlook is poor. When purchases of bonds increase, the associated yield falls, and so do mortgage rates. But when the economy is expected to do well, investors jump into stocks, forcing bond prices lower and pushing the yield and mortgage rates higher. So when the 10-year bond yield is up, mortgage rates are up. When the 10-year bond yield is down, mortgage rates are down. So a good way to predict which way mortgage rates are headed is to look at the 10-year bond yield. You can find it on finance websites along other stock tickers or in the newspaper. And as I said, if it's moving higher, mortgage rates probably are too. And if it's dropping, mortgage rates may be improving as well. To get an idea of where 30-year fixed rate mortgage rates will be, use a spread of about 170 basis points or 1.7% above the current 10-year bond yield. This spread accounts for the increased risk associated with a mortgage versus a bond. So a 10-year bond yield of 4% plus the 170 basis points would put mortgage rates around 5.7. Of course, this spread can and will vary over time and is really just a quick way to ballpark mortgage interest rates. Housing market conditions. Trends and conditions in the housing market also affect mortgage rates. When fewer homes are being built or offered for resale, the decline in homes being purchased leads to a decline in the demand for mortgages and pressures interest rates downward. A recent trend that has also applied downward pressure to rates is an increasing number of consumers opting to rent rather than buy a home. Such changes in the availability of homes and consumer demand affect the levels at which mortgage lenders set loan rates. The bottom line. Mortgage rates are tied to the basic rules of supply and demand. Factors such as inflation, economic growth, the Fed's monetary policy, and the state of the bond and housing markets all come into play. Of course, your own financial health will also affect the interest rate you're offered. So do your best to keep it as healthy as possible. Okay, that's the end of the presentation. Now, please go ahead and bring up your questions if you have any. Let me check the chat. Well, thank you for attending today. Our next Mortgage Monday presentation will be Monday, July 2nd. Topic yet to be determined. It'll be announced again through your training website. And again, thank you for attending. Please contact me if you have any questions via email, text, or phone call. Aloha.